Hi everyone. I don't know which of these two options you would choose. The first option is earning stable, consistent monthly profits. The second option is getting rich very quickly in a short period of time, but also having the possibility of losing both your capital and your profits. Surely you would choose the first one, right? You often hear about people making thousands or even tens of thousands of dollars per day, doubling or tripling their accounts daily. But all of that is just the surface. The profits you see might hide the fact that today's gain could be followed by even bigger losses tomorrow or the next day. In reality, anyone can make money from trading, but not many people can make consistent profits. Even a child who knows nothing can make money simply by placing a buy or sell order. The market only has two directions, up or down, so you already have a 50% chance. That's called luck. Today you may win big. Tomorrow you may lose big. Luck can help you make money for a short time, but it never lasts. To turn trading into a sustainable profession, it cannot rely only on learning a method. It also depends on building a strategy with measurable probability and clear statistics. So, how do you achieve consistent profits in this market? Are successful traders simply better at predicting the future? Most people believe we must learn many techniques to accurately predict the market's next move, but the truth is different. If you place a buy order, there is no method that can guarantee the price will go up afterward. So how can we profit from something that moves randomly? Let me give you a simple example. Imagine a coin with two sides, heads and tails. If I flip the coin and it lands on heads, you win $1.50. If it lands on tails, you lose $1. Would you play? If you only had $1 to your name, you wouldn't play. You wouldn't risk everything on a 50-50 game. But what if you had $100? That means you could play 100 times. Since the coin has a 50% chance of landing heads and 50 tails, over 100 flips, statistically, you would win about 50 times and lose 50 times. 50 wins times $1.50 equals $75. 50 losses times $1 equals $50. Your total profit would be $25. That means your average profit per trade is $0.25. From this example, we derive a formula for average profit. Average profit per trade equals win rate times average win minus loss rate times average loss. In the coin example, 50% times $1.50 minus 50% times $1 equals $0.25 per trade. Over 100 trades, you make $25. This is probability theory. If the number of flips is small, results are random. You might flip 10 times and get 7 heads and 3 tails. But as the number of trials increases to hundreds or thousands, the results move closer to statistical expectation. Even with only a 50% win rate, you still make money because your reward is bigger than your risk. Now imagine you win only 40 times and lose 60 out of 100. 40 wins times $1.50 equals $60. 60 losses times $1 equals $60. You break even. That means with a reward-to-risk ratio of 1.5 to 1, you only need a win rate above 40% to be profitable. This reward-to-risk ratio is often called the RR ratio. In trading, we control this using stop-loss and take-profit orders. For example, you may risk 1% or 2% of your account per trade. If you risk $1, your target should be at least $1.50 or more. If you apply this consistently, you will achieve stable profitability. In the short term, results are random. You may have a losing streak or a winning streak, but over a large number of trades, probability works in your favor. That is how consistent profit is built. Many beginners search online for best Forex strategy, best stock method, or Bitcoin strategy. You'll see countless methods, indicators, robots, price action, but very few people explain the formula for consistent profitability. Success in any field has two simple steps. Step 1, have a proven method with measurable data. Step 2, follow that method with discipline. Most traders skip step 1. They hear someone say a strategy works and immediately apply it with real money without testing it over hundreds or thousands of trades. Have you ever statistically tested a strategy over hundreds or thousands of trades? Or did you just learn it and start trading live? Price action, indicators, these are just categories. What truly matters is, does the method align with the fundamental nature of the market, buying and selling? Does it solve the profitability equation, win rate and RR ratio? Does it have clear entry and exit rules? A good method must be rule-based, not based on endless prediction. The more you analyze, the more confused you become. Anyone can predict whether gold will go up or down tomorrow. It's always 50-50. When starting, keep your RR ratio between 1:1 and 1:2. Markets fluctuate unpredictably. To verify a method, you must backtest it, which means you test it on historical data over hundreds or thousands of trades. Only then can you know its true win rate and performance. Many traders don't even know what backtesting is. They jump into live markets without knowing if their method works. Over time, their accounts decline. It's often said that 95% of traders lose money. That likely means 95% focus only on finding methods instead of building a complete strategy that includes risk management and probability. To build a good method, step 1, understand the relationship between win rate and RR ratio. Step 2, write down clear rules and backtest them objectively over hundreds or thousands of trades. Step 3, improve rules based on how markets move. Step 4, once proven profitable, apply it consistently with discipline. I hope through this video you now understand what creates consistent profitability, how to test a method, and how to build an effective trading system. That's the end of this video. See you in the next one.